Hello everyone, welcome back to Rise Finance. Today's video is for all those people who are just about to start their investing journey in the stock market. Let's check it out. Looking back at the way market has unfolded since start of 2022, any new to-be investor would feel jitters and think twice about having their money invested in the market. Who would not? Taking a look at the market charts, we see a dip of almost 10% in the S&P 500 index to start off this year. This is just not one stock we are talking about, but a group of 500 largest companies in the United States. Nasdaq, which is more technology sector inclined, has fared much worse with more than 15% decline. That is correction territory, which is defined as a decline of 10% or more in the price of a security from its most recent peak. Nasdaq, which was at its peak just recently around mid-November, was down almost 17% since then, which is just shy of a bear market consideration of 20% drop. That sure feels scary. Can anyone guess how much the market would fall? No. As we see here, there was a decent 8% rally since those low points at the end of January. Everyone was optimistic. But then what happens? Another steep fall of almost 4%. So, with such a roller coaster ride, how can a new investor navigate with caution? Can anyone become a fortune teller and buy stocks with surety? Can anyone predict the market bottom and invest with some sort of guarantee? Answer to these questions is a simple, emphatic no. Is there no way then? Don't get bogged down by all the negativity. There is a solution to this. This is where one has to keep index funds at the core of their portfolio. So, what is an index fund? An index fund is a type of mutual fund or an exchange traded fund. In short, we call it ETF, with a portfolio constructed to match or track the components of a financial market index, such as the Standard and Poor's 500 index. Mutual fund, ETF, what are these now? Let's first understand what these are. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Returns from these are passed back to the investors. Mutual funds are operated by professional money managers. An exchange traded fund, we call it short as ETF, is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or other asset. But unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way as a regular stock can. The main difference between mutual funds and ETFs is that an ETF can be bought and sold throughout the day, while mutual funds can only trade once a day after the market closes. Hope that was a fair understanding of mutual funds and ETFs. Let's dig deep into why index investing makes more sense. Money invested into a company like Meta, previously Facebook, will give you investment into only that company. If Meta does good, so will your investment, and same applies vice versa. Let's say you invested 100 into Meta at the beginning of the year when the stock was around $338. Till as recently as beginning of February, the price would have fallen around 5%. But just recently we saw a massive drop of over 25% in the Meta stock after its latest earnings spooked the market. That $100 investment is now less than 75. Investing in an index fund takes away the risk of investing into a single stock. With such investing vehicle, you're investing into not one, but 500 companies at once, thereby reducing your risk massively. the same $100 investment would be still holding a better value in an S&P index fund. Even the greatest investor of this generation, Warren Buffett, swears by index investing. Let's quickly go over this article. The first thing that we see here is stock picking is more difficult than it may seem. Yes, that's true. Nobody can ever forecast how a stock would do in the future. Will it go up? Will it go down? Nobody is sure. I would like to highlight a line in this article. 20 companies that were top as per market cap in 1989, none of them exist as of today. This is what I was referring earlier. That is a great argument for index funds. We see here I'm saying or suggesting investing in a low cost index fund. And this line here is very, very important for any new investor who is just influenced by the most flashy stock that they would have heard of from their friends making more money. Stock market is not a casino. Let's take a look at SPY and WOO, which are the most popular ETFs that track the S&P 500 index. SPY is the largest ETF in the world with almost $405 billion worth of market cap. It is run by Spider Services. We also have WOO, which is run by Vanguard, and that has almost $280 billion invested into it. Now, why are these funds so popular? Because they have been giving valuable returns back to investors for so long. Let's take a look at the S&P 500 index performance in the past. Consider a one-time investment of $12,000 invested into the S&P index 10 years ago in January 20. Let's select January 2012. Let's take till end of last year. Okay, so it's 12,000 starting, and let's, for just this calculation sake, we remove the any monthly investment and we click calculate. So what do we see here? At the end of 10 years, we see the investment grew almost to $50,000 with an average return of more than 15% every year. Even if you consider all the capital gains away, it's almost $45,000. So that's like $12,000 in 10 years, turning into $45,000. Now, yes, not everyone is expected to have such money to invest. This is where dollar cost averaging, shortly known as DCA, comes into play. Here, we invest a fixed amount of money on a regular basis, like monthly or bi weekly. If you have an employer provided 401k account, your investments are already invested like this. In this way, you are avoiding the concept of timing the market. In the earlier example, $12,000 worth of lump sum investment was made at once, and the market at that time could have been high or low. In dollar cost averaging, you are spreading out the buys and thereby averaging your purchase price. In a volatile market like what we are in now currently, this way of investing works to your benefit. You're buying at highs and lows of the market, and in that way, any psychological fear of stock prices going down can be avoided. In the same example, let's say how the dollar cost averaging would have played out. Let's keep the start and end timeline the same. So the starting amount, let's say you start off with $1,000 and monthly investment is 100 every month. Okay. And let's say calculate. What do we see here? The final portfolio value would be around $31,000. So your almost $13,000 is turning into $31,000. And if you keep away the capital gains tax, imagining that you would withdraw this money, that would be around $28,600. I'll share the link for this page in the description notes below so that you can also play around and see what your investment will turn out using the S&P 500 as your investment vehicle. With all said that about the S&P 500 index, let's see what does this index consist of. Now, if you had seen my previous video about the gig sectors, you can understand what all sectors are present in our stock market. Let's just take a brief look at what does this index consist of. So here, what do we see? So this is the composition of the entire index. Almost 29% of the index is made up of information technology companies. So here you will see companies like your Apples and Microsofts. Healthcare is almost 13%. You'll have your companies like Pfizer, AbbVie, your insurance companies like United Health Group and stuff. Now, consumer discretionary is like 12%, which has companies like your Amazon, Target, etc. Financials is 11%, which is all your banks, the JP Morgans, the Bank of America and stuff. Communications is 10%. Now, this is where your Netflix, Alphabet, Meta, everything come here. Industrials is 7.8%. You have your 3M, Honeywell, etc. Consumer staples is 6%, which has companies like Walmart. Energy has companies like Chevron, ExxonMobil. Real estate would have your malls like Simon Property or Realty Income. Utilities, these are the companies which provide your water, electricity, and gas, like Duke Energy, Nextera Energy, and stuff. Materials is like almost 2.5%, which has companies like your Sherwin-Williams, Nucor, Air Products, and stuff like that. So you see here, the index is diversified across all the sectors. Investing into an index fund makes your investment diversified instantly. Isn't that great? Now you would have a question. Who decides which sector has how much weight in this index? Now that is determined by the market cap of that company. A company having a higher market cap will have a higher weighting in the index. So your Apple, which has a market cap of almost 2.8 trillion, and Microsoft having almost 2.5 trillion dollars of market cap, they are like the topmost components of this index. So if you see here, you would see the top 10 constituents are Apple, Microsoft, Amazon, Alphabet, Tesla, then Meta, Nvidia, Berkshire Hathaway, and Johnson& and Johnson. So you see here the top 10 companies are so well known. This index is rebalanced every quarter. So what they do is every March, June, September, and December, they look at the market weights of all the 500 companies and see how much the market weight is and rebalance accordingly. So if a company has performed really well in that quarter, their weighting would go higher once the rebalance finishes. Say, for example, now that Meta has lost so much in value over the past few days. So next time when the rebalance occurs in March, and let's say Meta's value has still not gone up, it just stays the same way, then by the time the rebalance occurs, your Meta, I would say, which is currently at what, sixth place, accordingly may go lower. So they simply find an index in this way rewards companies who have done much better by giving them a higher weighting in the index. So what are the options that investors have to invest in an S&P 500 index? So like we saw earlier, we have SPY, an ETF, and also we have BOO, that's also an ETF. On the mutual fund side, we have VFIAX from Vanguard that tracks the S&P 500 index, and from Fidelity we have FXAIX. So to reiterate, for any new investor, the ideal way to start investing is with an index fund. That way, one would get to know how the market behaves over time. After getting used to the volatility, then they should look at individual stocks. Now, how to select good stocks is an altogether different world. We'll discuss about that in a future video. I hope this video was helpful. in realizing the simplicity of investing in the S&P 500 index. Thanks for watching. Please like and subscribe to my channel to keep informed about all such informative videos in the future. I'm not a financial advisor, and all the content you would see in this channel is for educational and entertainment purposes only. Everyone should do their due diligence before investing their hard earned money. Thanks. Bye.